All right, hello everyone. Thanks for checking in with the Stock Market Jobber. I'm Mark. I am the Stock Market Jobber. It's kind of my alter ego. But anyway, unless you're been living under a rock, and maybe even if you are living under a rock, depending on what rock it is, you know that there's a lot going on in the banking sector. Now, in my opinion, this is going to get more widespread. I'm not recommending you buy bank stocks now. Eventually, there will be a time. I don't think we're there yet. I mean, it just seems like they're putting band-aids on cancer here. You know, I mean, we thought that this one bank was saved and it wasn't. We thought this other bank was saved and it isn't. A lot of bank experts, which I'm not. I mean, admittedly, I'm not a bank analyst, but I've talked to people that know a lot more about banking than I do, and they say that there's more to come. And the problem is this, right? It's just stupidity and incompetence on all these levels. Now, for those of you who are interested in why Silicon Valley Bank blew up and these other banks blew up, well, it's because the people that run them are pretty much incompetent. And I hate to say that, but I think it's kind of true. And the sad thing is they get paid millions of dollars and they're going to walk out of there with a lot of money. And the regular bank person, the person who's the teller or whatever, the lower level person is going to lose their jobs. Now, here's the problem. Silicon Valley Bank put a bunch of their assets into bonds. Okay, bonds are historically considered very safe. But when interest rates go up, the value of bonds goes down. So just say, hypothetically speaking, a bond pays 7%. All right, the government issued bond, they issue it at $100. It's got a 7% yield. So if you own it, you get $7 of a dividend a year. Now, if interest rates go higher and say you can get a yield that's better than that 7%, you're going to sell those bonds and go over to where you can get the higher yield. So higher interest rates push the prices of bonds down. Now, here's the incompetence is why didn't these people who are running these banks who are getting paid all this money, why didn't they realize that they should hedge their portfolio? Hedging basically means if you have a portfolio and it goes down, well, you have something in your portfolio that goes up. Most investors or traders think of these as puts, right? A put option will go up in value as the price of whatever it's a contract for will go down. So I don't get it. I don't understand it. It seems like it was obvious. Everyone knew inflation was coming. Of course, I have to mention that this inflation we're experiencing is all self induced. Okay, the energy policy of our administration literally led to wars and famine. Okay, because this whole like Putin price hike thing is just so asinine and so stupid. When Biden took office, the price of oil was about $32 a barrel. When the Ukraine war started, the price of oil was about $100 a barrel. Do the math. Are you a Wall Street guru? No, you don't need to be. Well, you can know if the price of oil triples, well, gee, that's inflation. And here's the thing. The Russian economy is run on oil. That's their main export. So when oil got to be $100 a barrel, well, guess what? Putin can sell this oil, and he used that to fund the war. So I'm sorry if you don't like to hear it. I'm not a Republican. I'm not a Democrat. I just state it like it is. We have an administration whose energy policy has literally led to war and famine. But let me pull that back in and let's just go over to the banking sector here. So the inflation has caused these bonds to go lower. Now, I don't know why they didn't hedge themselves, but whatever. Let's go into the banks here. This ETF here is the symbol's KBE. This is an ETF which tracks the banking sector. Now, notice how we had this big sell-off. And where did we find support? Around $35. So this is a basket of bank stocks, okay? And it's a 3-year chart. This shows you a really important principle of markets. It's called market memory. It also shows another principle, and that is that seller's remorse can turn resistance into support. Resistance is a level where there's more supply than demand. If a market's going up, there's not enough supply to fulfill the demand. So the buyers or the demand side of the equation needs to pay higher prices. When we get to resistance, well, the tide turns. Now, eventually, resistance breaks or support breaks. Remember, this is a long-term chart here, so we're looking at basically 6 months here. So the market goes higher. A lot of the people who sold here decide, oh man, I made a mistake. I'm going to buy my shares back, but I'm only going to do so if I can get them for the same price I sold them at. So if we have enough of these remorseful sellers placing buy orders at the level they sold at, resistance can turn into support. All right. And that's what happened here. It's not a coincidence that this basically a crash. This isn't even a sell-off. This is a crash. Found support around 35. If it holds and if we hear some stuff out of the Fed that makes us confident that the banking crisis is over, this thing is going to bounce. Now, do I think that's going to happen? Probably not. But this is more of an educational 5 charts than a tell you what to do 5 charts. At Stock Market Jobber, we don't like to tell you what to do. We want you to learn how to teach yourself what to do, because we recognize that everyone is different and that what works for one person might not work for another person. Everyone has a different personality. Everyone has a different style. Some people may be more short term. Some people may be day traders. Some people might be long term. Some indicator might work for one person because they view it differently than another person. If you're not going to be successful in this game if you just let people tell you what to do. If you want to be successful, you need to figure out what works for you. What style fits your personality? All right, so let's go on to the next interesting chart in the banking sector. So this is the First Republic. You've probably heard about it. It was halted on and off today. The reason why I included this chart is it just shows you how things can change. In the last month and a half, this stock has lost 90% of its value. Think about that, 90% of its value. And this is not an internet company. It's not a biotech company. You see this in biotech companies. A lot of biotech companies, I call them one-hit wonders. They're founded upon one patent or one invention. And if their trial doesn't go well, we see a collapse. To see a collapse like this, 90% in a month, is just monstrous for a bank. Like this just doesn't happen. Well, I mean, it happened now, but this is highly, highly, highly unusual. And my instinct tells me that this is going to unwind and we haven't seen the end of it. So that's why I said I'm not really giving a recommendation. If you want a recommendation, you can look at our trade ideas. This is more of an educational piece. And I just want people to understand the, I don't even know what the word is, just the, incredible historical stuff that's going on here. For a bank to lose 90% of its value, even while you have JPMorgan coming out and saying, oh, we're going to save them, blah, 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 it's still going lower and lower and lower. It's like someone's out there drowning in the ocean and people are throwing them life preservers and lifelines and they're just not getting them. They're just not being able to swim to them and they're just going to go lower. All right, let's go see our next chart here. Now, here is JP Morgan. I wanted to include this because this teaches a pretty interesting and technical analysis lesson. How support can become resistance. See here, support became resistance, support became resistance, support became resistance. How does this seemingly amazing dynamic happen? Why would a level that was support become resistance? Market's going down, not enough demand or buyers to absorb the supply, or sellers get to support, and things change. There's a lot of buyers. Now, think about it. Market goes higher, goes lower. A lot of the investors who bought here regret their decision to do so when the price goes lower, and they tell themselves, I'm going to get out if I can, but I'm going to only do it if I can get out at break even. So when the price comes back, we have remorseful buyers placing sell orders at a level that was support. If we have enough remorseful buyers placing sell orders at the former support level, the level can convert into resistance. We see it here. Support becomes resistance. Support becomes resistance. All right, so we can see this on a lot of charts. Now, let's move much forward into the recent past, and we can see here resistance becomes support. This is the seller's remorse, right? Investors who sold here regretted doing so, or a lot of them at any rate regretted doing so when the price moved higher. And they tell themselves, I'm going to buy my shares back, but I'm only going to do so if I can get them for the same price I sold them at. So buyer's remorse turns support into resistance. Seller's remorse turns resistance into support. We rally. Where do we run into resistance? At a level that was resistance and support before. This is market memory. You just got to get it, right? In this stock market, or actually in any financial market, there are some price levels that are more important than others. That is just the truth. That is just the reality of markets. Now, we broke down through this support. Looks like we're going to be in range here. 130 on the top, 123 on the bottom. Again, this is not a recommendation, but it's just, I just like my students or followers to know how these markets work. So many people overcomplicate things. It doesn't need to be that way. I was an institutional trader for more than 2 decades, and in that 2 decades, I picked up a few things. And one of them is that you got to pay attention to these important price levels. So if we go down lower, there's a good chance there's going to be some support around 123. Why? Because it was resistance level, seller's remorse. If we rally, good chance there's going to be some more support around 130. Resistance around 130. Why? Buyer's remorse. So we could get into a range here, 123 on the downside, 130 on the top side. Okay, let me go on to the next chart here. Here I want to give a little bit of a lesson about a capitulation and what is possibly a capitulation. A capitulation happens when, it could happen on the upside or on the downside. In this case, it's on the downside, so I'm just going to focus on that. A capitulation happens when sellers get so frustrated from watching the price go lower and lower and lower, they just throw in the towel and they say, you know what, I want out of this. I hate this stock. I never should have gotten into it. I'm going to tell my broker to sell it at any possible price. I don't care. Make it go away. And as a result, you get these huge spikes in volume. PacWest Bancorp, this stock averaged about 2 million shares a day in trading. It's up over 80 million. That's a massive, huge amount of volume. So pretend you're a trader, an institutional trader. You got a lot to sell a little here, you sell a little there. You keep waiting for the price to come back, meaning it goes higher so you can get a better price on your sell order. It doesn't happen. Eventually, you just get sick of it and you throw in the towel. Now, this could be potentially a bullish dynamic because if all of a sudden investors start to think like, oh, gee, this news is not as bad as we thought, or the government, by some miraculous thing, gives people confidence that they're going to be able to bail it out. When buyers come back into the market, guess what? There's no sellers around. There's a lack of sellers. So in order to buy their shares, they're going to have to be willing to bid at a premium. They're going to have to say, you know what? It was at 10. There's no sellers there. I'm going to bid 11. Not enough sellers to fill my orders at 11. I'm going to bid 12. So it forces the market into an uptrend. So capitulations can be a sign of a trend change. Once again, I am not giving you a recommendation. I'm just trying to teach you a little bit about how the markets work. All right, so now for our last chart. Here's Wells Fargo, and they better stay around because this is where my bank account is. But here we can see our important levels. Look at this $46 level. You don't need to be a market guru to see it. Support becomes resistance. Remember, buyer's remorse. People bought here. When the price goes lower, they regret doing so. They tell themselves, I want to get out, but only if I can get out at break even. If you have enough remorseful buyers placing sell orders at a former support level, it converts into resistance. Here, resistance converts into support. If you have enough remorseful sellers who regret selling when the price goes higher, who tell themselves, I'm going to buy my shares back, but only if I can get them for the same price I sold them at, the level that was resistance becomes support. And it happened here. Now, we have a support level down here. We have a support level here. This is called market memory. A lot of times these levels that are important can stay intact for a while. Resistance, resistance, support, support. And we're very oversold. Oversold means that we're trading below what would be a typical or normal or historical trading range. It basically means the sellers got freaked out and they're just selling. They want out at any cost. There's a market principle that stocks or markets that are oversold that get to support tend to bounce. What is support? It's a large collection of buyers. oversold conditions attract buyers into the market because they're expecting a reversion. So the lesson here is that oversold markets that get to support could bounce. I mean, I don't want to guarantee it because nothing is a guarantee in the market or in life. But if another bank comes out and says we're going under, this could go lower. But if things seem to normalize, it's a good chance we're going to bounce up here. Remember, oversold conditions attract buyers into the market. A support level is a large amount of investors who are looking to buy. So you got this double whammy going on. All right, everyone, that's all I'm going to go with tonight. I appreciate it. Make sure you sign up for our YouTube page, Stock Market Jobber, and I hope to see you soon. Thank you, everybody. Happy trading. I'll talk to you soon. Thank you.